Hi, I'm Brien Lundin, and you're watching Market in 1 Minute. I have with me a longtime friend of mine, Frank Holmes, CEO and Chief Investment Officer of usfunds.com. Frank, you wrote a book on gold. You literally wrote the book on gold and gold investing. Can you tell us a little bit about some of the theses that you put forth in that book?
Well, there's three key factors, I think, in the book. One is the 10% rule. You should have 10% weighted in gold, and of which 5% are gold coins, gold jewelry, high-end gold jewelry, and 5% in gold stocks. The other two factors is what drives gold demand. I think the biggest thing is to try to explain to investors with clarity and simplicity that there are two demand drivers. The fear trade, which dominates media, and then the love trade. And the love trade has become very significant because of Chindia, China and India, GDP per capita rising. You've seen a huge consumption of gold in those nations.
And you know, I think investors who follow the mainstream financial media aren't really aware of how gold demand in China has just soared. It's far above what even the World Gold Council has been reporting to the mainstream media, and is actually being reported by some outlets, by you and your work, and some other newsletters in the industry. But it's absolutely soared. China alone is consuming the majority of newly mined gold right now.
The World Gold Council did a wonderful job years ago getting them into the bank's dollar cost average programming, which they do with mutual funds. But the magnitude is huge in China. Just because they have 1.3 billion people, all you have to do is have 5% doing it, and it's a natural consumption pattern that's very strong. But also, what's very smart about China, and it goes back from Deng Xiaoping to turn around that nation in '78, he created 7 tax-free zones. Well, Shanghai has become a tax-free zone for gold trading. And that has been a real institutional shift.
And they've opened it up internationally, and they want to have a say in how gold is priced.
They want to be the price maker, not the taker. And I wrote about that in my investor alert last April.
Now, Frank, your group does more fundamental research in the resource industry, and primarily the metals, than I think anybody else out there. You're following one indicator specifically right now that you think is vitally important. Can you tell us a little bit about that?
I think, Brian, that the important indicator is PMI, not GDP. GDP is looking out the rear view mirror. PMI, which is Purchasing Manufacturers Index, is looking down the street 6 months. And so that's very important to take a look at it. So we did this regressional research that showed that if the 1 month is above the 3 months for global PMI, then there's strong demand for all commodities. When it goes below, all of a sudden oil falls, copper falls, iron, steel fall, and that's what we saw last year. The global PMIs turned negative.
You actually predicted the fall in oil.
Well, I don't want to predict, but using those tools, we saw this huge shift take place last summer, and then couple that with a strong dollar, we said be careful.
And what do you see that indicator showing right now for the future?
Well, it's still sideways. The big factor that's dragging it down is Europe. Europe is really taking it on the chin, and they're so slow. They have regulations for regulations for regulations, and the process in China is totally different. PMI came negative in China, immediately they dropped interest rates, and they have a home program for stimulating construction.
And you talk a lot, you stress disciplined portfolio allocation. A lot of people don't realize that gold in an investment portfolio has been proven to increase the risk-adjusted return of a diversified portfolio. Tell us a bit about what an investor needs to do to maintain the proper allocation of metals in a portfolio.
The simple rule is 10% and rebalance every year. But maybe on your birthday, you
and
just
rebalancing is something that
that's
people typically forget to do.
Because of the volatility. So last year, gold was the second best currency of the world. If you're in the fear trade, it was number 2. Number 1 was the dollar, and now we're seeing in Japanese yen terms, in rand terms in South Africa, in Europe, gold is breaking out. So there's tremendous volatility in currencies. Gold tries to protect that volatility for investors.
So investors should really follow your reports and to watch that indicator and see what it says about the future.
I think it's helpful, and they just go to usfunds.com and look for the investor alert, and we publish on a weekly basis, and it goes to 170 readers, readers in 170 countries.
Great, Frank. Great insights as usual. Thank you.
Well, best in 2015.